Happy Monday, everybody. I hope you had a great weekend. Today is May 8, 2023, and this is your Monday market update. There's a lot to review, so let's jump right in. A quick note, you may notice that our new website is up and live. Please feel free to look around. In addition to the most recent videos, I'll also be posting a blog on that section monthly. Check it out at www.randycohenihtwm.com or check the notes for the video in YouTube for the site address. Okay, last week ended mostly in the red, but a lot of ground was covered to get there. The Dow and the S&P were both down on the week, and the NASDAQ was barely in the green. Let's see how all that came about. On Monday, stocks started flat, even as they reacted to the news that JP Morgan came to the rescue of First Republic Bank. And once again, the branches that closed on Friday as First Republic opened Monday as Chase Bank. In case you were worried about banks getting too big, the government did have to waive the restrictions that was in place that does not allow any bank to hold more than 10% of all U.S. deposits. Too big to fail? We'll see how that goes. The markets were squarely set on watching and positioning for the Fed announcement coming later in the week. Markets tried to go positive. With the quiet newswire, the FDIC did pour some cold water on things, as the most recent comments do not indicate them going anywhere near full deposit insurance, which is something the markets would like to have. Can anyone say accountability? May Day on May 1, and though it was a labor holiday of sorts, we now have the Writers Guild of America on strike. Add to that the American Airlines pilots, UPS, and others on the verge of, if not already, striking, and you would not know that U.S. union membership is at 10% last year. It is near the lowest on record. And all this while the Fed watches labor and the 1.6 jobs for every eligible employee, according to the ECO data. For the day, all three indices were down just slightly, none more than 0.15%. The debt ceiling talk again, we'll get to that in a moment. Quick check on earnings. Remember those things? By Monday, about half of all S&P 500 companies had reported blended growth rate at negative 3.7%, which is so much better than the negative 6.7% that was estimated back in March. 80% have beaten the lower bar for estimates, above the average, above the average broad-based. A total of 3% of the NASDAQ are at a 6-month high, not too broad. So we'll see how that goes. Stocks gapped lower on Tuesday as the market digested more news. A surprise 25 basis point hike by the Royal Bank of Australia was the negative, and the ECO data was relatively tame. Solid earnings, ECO data, and the Fed even took a backseat as regional banks. Remember those? They went into what seems like a free fall. As I mentioned last week, this is an emotional thing. One cannot but think back to the great financial crisis, though we are nowhere near in the same position. Although if you tell that to PacWest, they may disagree. No new negative or positive news for the most part, but sentiment is pretty negative. Add that oil is breaking down to new recent lows. The markets are not too happy, but think lower energy prices. Remember, jobs numbers in the JOLTS report did show a decline, but still very high. Dow closed the day down about 1%, S&P just under 1.25%, and the NASDAQ was down about 1%. Time to just mention how crazy things seem to be. In case we did not have enough eco data, let's watch the Atlanta Fed's sticky price CPI and how it compares to the flexible price CPI. Okay, that's just another one to keep an eye on. I can't make this stuff up. Stocks opened slightly higher on Wednesday as the markets got ready for the Fed decision. Also, digested news on AMD and the banks. ADP labor report came in a bit on the hot side with some price components looking inflationary also. All eyes were on Powell, though, and the Fed, 2 p.m., the release. As expected, the 25 basis point hike. Also, as expected, markets went all over the place, spiking to session highs on hopes of a pause. Gains did not hold, as Powell explained the release, and did not allow anyone to leave the room with the thought that the Fed was in official pause mode, for sure. May seem like it, but not for sure. At least he did not want anyone to be too clear on that. He did push back on the idea that they would need to cut rates later in the year. The higher for longer seems to be where we're heading. As I've been saying, this leaves us to watch the eco data, and it will lead the way, although I continue to think that earnings and the valuation are the ultimate decision maker. By the end of the day, the Dow was down about 1%, S&P down about 0.75%, and the NASDAQ down about 0.5%. As Thursday opened, stocks gapped lower again with a focus on banks. There was a big earnings miss in the tech sector, Qualcomm, and that did not help things, as global central banks are pretty close to the same page. The ECB raised rates by 0.25%, and that was a relief to some, as there was a whisper of about 0.5%. So all eyes are now focused on the jobs report on Friday. Western Alliance Bank was the latest to be under attack. This set of bank attacks does smell a lot like 2008, 2009, but it is my opinion, and you're hearing a lot of this right now, that the banking system as well as the economy are in a much different place than they were then. Markets are continuing to price in late year 2023 rate cuts. I'm still not in that camp yet. Things did stabilize in the afternoon. Markets did end the day lower. The Dow was down about 1%, S&P down about 0.75%, and the NASDAQ was down about 0.5%. Another one of the deep readings of EcoData. Last week, we saw that vessel tracking data showed the amount of seaborne crude headed for China hit a 2-year high. Global demand growing again? Yes, vessel tracking data. Stocks rebounded Friday on the heels of good Apple earnings, and recall how much the indices Apple represents. The jobs numbers for this month, when you bring into the calculations of revision, was pretty much Goldilocks number for things as they are. Tech got a bid from Apple. Banks got a bid with some research from JP Morgan, talking their book. Not so sure about that. We'll see. Markets rallied hard, and the S&P tested the 4150 level, pulled back a bit when Bullard got back in the mix. Fed heads will be back. Their blackout period is over. Markets ended just off session highs. Dow up about 1.75%, S&P just under 2% higher, and the Nasdaq was up 2.25%. As I mentioned for the week, the Dow and S&P still booked their worst week since March. Nasdaq eked out a very small gain on the week, just barely. Going into this week, we had the Berkshire annual get-together in Omaha, and that will be the news, at least for the first few days of this week. A lot of Buffett watchers, and for good reason. We have another big earnings week, and just to say it once more, I do think that earnings do matter. Valuations have to match up at some point, even if John Maynard Keynes said markets can remain irrational longer than you can remain solvent. In addition to the earnings, we'll get CPI and PPI this week. So much is being talked about when we'll see the dropping prices start to show here. Energy, rent, eggs, we'll see what happens to that. Bank of England is also meeting, and we'll see if they keep the script. We will get the Senior Loan Officer Survey. That's today, and that'll be a very interesting read on this time. And not to be left out, since we are out of the blackout period, Fed heads return. Kashkari, Jefferson, Williams, Waller, Daly, Bullard, and Cook. Finally, let's focus back on Washington. Expect to see more action from Capitol Hill. More for the cameras, at least. I still don't think we'll see this go past the deadline, but just to get an idea of some history, I do try to keep that data in front of you. In 2011, in case you have not heard this 1,000 times, we had the last major debt ceiling crisis. We did hit the ceiling on May 16, but they did fund the government until August 2. But we'll have to see how this goes. This time, June 1 is the latest date. In 2011, make no mistake, the market did not react well to the bickering in D.C. From the April high to the October low, according to LPL Research, the Nasdaq was down 13%, and that was the best of the list. S&P was down 19+%, and the Russell 2000 was down almost 30%. Sector performance wasn't so much better. Utilities were the best, just under 1% down. Consumer staples were down almost 7%. Healthcare, that defensive one, down 12.5%, and info technology down 14%. Energy down 28.5%, and of course, financials down over 30%. Like we need more pressure on the financial side. Just to return my overall optimism, LPL Research itself and many more do still believe the odds it will default remain low until we get a deal between Yellen's warnings, got one the other day, and the overall headline wranglings in D.C. The markets will certainly continue to bounce around. The volatility will stick around as well. I maintain my opinion that the train has not left the station. The S&P is about where many of the smart people think we'll end the year, and I don't see us just sitting around. Keep an eye on the data I've mentioned, earnings, and the eco data. As always, this is a short-term noise that should be considered but not focused on as we stay laser-focused on reaching your goals. Regardless of the markets, this is what we keep talking about in our meetings, and this is what I'll keep coming to you in the Friday planning videos and other content on the new website. Please stay in touch. I'll keep you informed with all the videos and all our conversations and meetings. Keep to the plan and make sure you know what that plan is. Have a great week.